Hi, I'm Tom Mihawk, and welcome to this chapter on taxes, and welcome to my personal finance course. Taxes are an incredible topic. They can be boring, and hard to learn, but they're so key to know so you can manage your personal finances. Let's take a look. About a third of everything you earn goes to pay taxes every year. It's closer to half if you live in some areas like New York City and other parts in the country, but New York City in particular. Tax Freedom Day is mid-April, which is basically about a third of the year. It represents how long into the year you must work to pay your taxes. And then after that time, theoretically or metaphorically, you begin to receive your money without taxation. So types of taxes: earnings, like on income and Social Security tax; property, capital gains tax, which is selling property at a higher value than what you purchased it for; real estate and personal property taxes, real estate like for your home, personal property maybe for your automobile. When I lived in Virginia, we had a personal property tax on automobiles. Wealth, in estate tax, inheritance tax, gift taxes. Those are assessed generally when you transfer property at your death. Gift taxes are assessed when you transfer property before your death. Tax authorities, federal, state, local, and there are some others too. You will file a tax return for all those you qualify for. So if you live in a large city, you'll pay federal tax to the IRS, state tax to the state in which you live, and city tax to the city in which you live. If you don't live in a large city, you'll pay maybe just federal and state income taxes. Most days, therefore, because of all these taxes, most days include some activity that's a taxable event, whether you're buying something at the store, earning income, purchasing gasoline. I mean, you name it. Many activities in a normal day involve some kind of taxable event. Taxes are challenging to learn and memorize, but it's critically important knowledge. One of the most boring courses I took in my Masters of Financial Services program was tax. It's very hard material to follow. Unlike many courses of study where one thing follows from another, taxes don't do that. In general, taxes are promulgated when the government needs more revenue, or when a new administration comes in that believes taxing is more valuable, or finds that it needs more revenue. And in general, tax structures have philosophical elements. So for example, the marginal tax bracket system says that if you don't make much money, if you don't earn much, you pay a very low tax rate. The idea being that those that earn less can afford to pay less in taxes, and the more you earn, the more you pay. But you'll see in a later slide how that's calculated and how it's designed so that only cohorts of your income are subject to higher taxation rates. Lower groups or cohorts are subject to lower rates. The deductibility of home mortgage interest provides an incentive for people to own homes. Home ownership is viewed as good in general for society. Traditional and Roth qualified plans are designed so that people will save for their future, save for their retirement. And so they're given an opportunity at tax deferral and other benefits. Income taxes are due on April 15th of the year following the tax year. Withholding each paycheck, for example, goes toward paying your tax liability. When you receive a paycheck and it has taxes withheld, you haven't paid the tax yet. Many people say, well, here's what I paid in taxes, and you haven't paid it yet. You actually pay your taxes on April 15th of the following year. You calculate that, and we'll go through some of this, how these calculations are done. You calculate your taxes, and then you look at what's been withheld against that calculation. If you owe more than, if you calculate more due, you pay as of April 15th, and if you've withheld more, you get money back or you get a refund. So you're really truing it up on April 15th, and the withholding that happens through your salary through the earning year is only withheld against your taxes that are going to be due on April 15th. It's important to learn tax concepts. The numerical details will change, but the concepts persist. knowing things like the way marginal tax brackets work, but the tax rates change. Knowing how much you can put aside a year in an IRA or a 401k. The amounts change, but the concepts stay the same. Understanding how deductions work. The numbers may change and how much you can deduct may change, but the concepts stay the same. Have a great record system. Keep your receipts, your tax returns, and your related records. I have all my tax returns in here. These are filing drawers. I don't have all of them. I have the most recent ones, but I do have all of them going back, not just in my filing drawers, but upstairs in my attic, going back to when I was single, which I shouldn't. You know, the experts say 7 years is long enough to keep your tax returns. I've kept them longer. Pay an amount of taxes that is fair for a good citizen. If I'm your financial advisor, however, and I'm not a tax advisor, I'm just a financial advisor, but my goal is to help you pay less in taxes. And the goal of personal finance, your goal watching these videos or studying this material in one of my courses, is to understand the tax laws to permit some choice in your taxation. With knowledge, those who know more or know the most have the ability to lower their taxes. Be aware and stay aware of opportunities to lower your taxes. Pay what's appropriate, pay what's right and what's fair as a good citizen. But if you know more, you have the opportunity to make choices that allow you legally to pay more in taxes. It's the way the tax laws are designed. Okay, here's income taxation flow. This is from the Kapoor text, this chart. It looks complicated, but what you need to know is that it goes in a couple of stages. First, you aggregate all of your income, and you make adjustments to that income to arrive at adjusted gross income, and that's what's reported on Form 1040, the primary income tax reporting form. Deduct the standard or itemized deductions. The standard deduction is an allowance made for everyone of a certain category. Know that you file in certain categories. Single, married filing jointly, married filing individually. There's a category for when you support someone else, and you need to compare categories. If you qualify for, say, 2, compare which would be the best for you. So the standard deduction goes with a category. The itemized deduction is when you list all of them and then find which is best for you. The higher amount of deductions, either the standard or the itemized, is what you would use because it lowers your income. Remember, what you want, or maybe this is for the first time, but what you want is high earned income, which supports your lifestyle, your savings, your investments, but low pre-tax income, which gives you lower taxes. High earnings, low pre-tax or taxable income. They're the same. Calculate the tax using marginal tax bracket system. Add to that any other taxes that are due, subtract any credits that you're allowed, and this is your total tax that's due. Compare to the amount withheld during the year, as I mentioned in the earlier slide. This is the amount that's taken out of your paycheck every year. If you receive a paycheck, you may pay yourself. If you're self-employed, you have to pay quarterly, and you have to make sure you adjust accordingly. So you owe more or get a refund based on how your withholdings match up to what you calculate but based on this flow chart and based on your calculations. Now, this is key. Another key thing, right? The marginal tax bracket system. So in the example on the left, there are three tax brackets, the 10%, 12%, and 22%. This is for a $95,000 earner. Notice they pay all the tax at 10% required in this range of $0 to $19,050. That adds up to $1,905. The next bracket takes the next amount of income, $19,050 to $77,400. Their total was $95,000. So they haven't gotten there yet. So they filled up the first bracket at 10%, the second bracket at 12%. The second bracket, by the way, produces tax of $7,002. And the last bracket, they fill up from $77,400 to $95,000. That's what they earned. And that calculates to $3,872. When you add up 1905, 7002, and 3872, you get $12,779. That's the total tax due. In the example on the right, we have another way of showing it. It shows these buckets of taxation that go up, 10%, 12%, 22%, 24%. This example shows a $200,000 wage earner. It fills up the first bucket completely at 10%, the second bucket completely at 12%, the third bucket completely at 22%, and it fills up a tiny little bit. 11,000 is all that's left in the 24% tax bracket. The total taxes add up to $30,819 on a $200,000 income. Now notice when you calculate this using your calculator, you get an average tax rate on the left example of 13% and an average tax on the right example of 15%. This is the average rate, the total tax relative to the income. You don't pay 22% on all of your income, or in the example on the right, 24%. You pay it only on the topmost amount. You fill up the other buckets completely. The 10%, 12%, 22% on the left example, 10, 12, 22, and 24 on the right example. I'm pointing the wrong way, sorry. But you get my point. The average rate is lower than the highest bracket. These are actual tax rates for the 2020 income tax year. 10, 12, 22, 24, 32, 35. They're always changing. They stay the same for a few years, then they change. So you need to know that you need to know how the marginal tax bracket system works. The numbers change a little bit, the percentages change, but the system, the methodology of calculating using the marginal tax bracket system stays the same in general. Well, it has for all of recent history. It may change in the future, but it hasn't changed yet, and there's great resistance. By the way, philosophically, the reason this is done this way is that a low earner pays less in taxes. A low earner has less ability to pay tax. So low earner gets to pay 12% if they made less than, say, $14,100 and they were head of household or head of household, for example. It's $19,750. If they made less than that or up to that, they would pay 12%. If they're married, filing jointly, as an example. So here's the current tax form, Form 1040. It's a lot smaller than it used to be. Notice you have your name, your address, any dependents in the top, you have your signatures. Then on the right side, this is all of what used to be pretty much on 2 pages. At the top, wages and salaries. You reduce your income by your standard deduction or the itemized deduction. This goes back to the flow chart that I showed earlier. You calculate your tax, show what's been withheld, calculate what's still due, and show what's either going to be refunded to you or what's required to be paid by you relative to how much you calculate that's due on April 15th. This was a big deal, reducing this, what used to be on 2 pages to 1 page. Okay, deductions and credits, critically different. A tax credit is a $1 for $1 benefit. If you get a $100 tax credit, you reduce your taxes by $100. $10,000 tax credit, reduce your taxes by $10,000. Deductions, on the other hand, only reduce your pre-tax or your taxable income, which are the same. So a $1,000 deduction saves you $250 if you're in the 25% tax bracket. So basically a $1,000 deduction really costs you $750. Think about when you make a $1,000 mortgage payment. If you're in a 25% tax bracket, a $1,000 mortgage, because if it's fully deductible, if it's at the beginning of, for example, of a mortgage, over time there's more principal, and principal payment, which goes to reduce the balance, is not deductible, but the interest is all deductible. So in the beginning, when there's all interest, a $1,000 mortgage payment in a 25% tax bracket saves you $250 in taxes and really costs you $750. Here's the form that you file your deductions on. This is Schedule A. It lists itemized deductions such as medical expenses, state and local taxes, real estate, charitable gifts. The standard deduction for married filing jointly is $24,800, and for single person, $12,400. If your itemized deductions exceed these amounts, file this form and use the itemized deductions. If your itemized deductions don't, use the standard deduction. It's a very common form, and this is another way to if you have charitable contributions or high local taxes, high state and federal taxes, for example, high state and local taxes, I'm sorry. This is another way that you might lower your pre-tax income and have still a high earned income. This is the end of segment 1 of the tax chapter. I'm Tom Mihawk. Here's where you can find me. Please come back for the second segment. Thanks very much.